Okay, well, thank you for inviting me, Eugenio. It's great to be here and hoping you're all staying safe out in Madrid. So you're totally right. My background started in traditional finance. So I traded fixed income futures for Bank of America Merrill Lynch in London before moving to the buy side. So I moved to a global macro hedge fund, and it was a hedge fund that's described as systematic. So a systematic hedge fund is one where, just as I was just mentioning, they have their own model where they have lots of quantitative analysts that help build this model, and that will choose how they trade in markets. I was there for a little while. Then I went to Cambridge. In fact, that's where I met Eugenio. And now I run a cryptocurrency quantitative fund, right, as well as an academy. So we'll start with the academy. The academy is where we develop new traders. So we bring on people that perhaps have never traded before, or they've had a little bit of experience. They need that mentoring and help to get up to a level where they're good and profitable. They go through one of our training programs, and then we give them capital. We fund them. Well, they start with $12,500, and then if they hit certain targets, we give them more capital, all the way up to $2 million per trader. So that's the academy side, where we develop new traders. If they do well, we give them capital, and we split the profits with the trader. Now, what I run is the fund, the cryptocurrency fund, where we trade the major cryptocurrencies. So these are Bitcoin, Ethereum, Litecoin. We don't trade any smaller tokens, only because they are hugely rife for manipulation, right? So if I'm the founder of, I don't know, Smallcoin, when I create Smallcoin, I may allocate myself 50% of the tokens and then give everyone else in the world the other 50%. So that means when I want to sell my 50%, I'm going to move the market considerably. So as a trader, we can't trade in that environment. We don't know when the founder is going to sell his share. He can massively move the market. So we only trade the majors, which is Ethereum, Bitcoin, and Litecoin. So we run a quantitative model, and what this does, it finds trends in markets. It's also known as a trend following model. So we'll look at Ethereum and Bitcoin, and we're looking to identify when trends emerge, and the model will tell us when to buy or sell based on that. So we spent a lot of time and resources developing the model, a lot of back testing. You want to see how well it worked since markets began in Ethereum and crypto. And again, as I mentioned before, you want to be careful not to over-optimize, which is when you make it fit perfectly to previous prices. Now, obviously, the future isn't going to be the same as historic, so we want to make sure it's adaptable and flexible enough for different market scenarios. So we run two core strategies. One is a short-term trend-following strategy, and one is a long-term strategy. They are what they say. One is trading over much shorter time frames. It will trade much more often, perhaps, I don't know, maybe 10 trades per month, perhaps, not that many. Could be a lot smaller, could be more. And a long-term strategy does maybe 5 trades per year, only a small amount of trades, but it holds them a lot longer. It might hold a trade for a month, 2 months, sometimes 3 months. So there's two different kind of strategies, depending on the investor's risk appetite. If an investor wants more risk, they go into the short-term strategy. If they want less risk, they go into long-term strategy. So why do we trade crypto? So there's lots of asset classes that you guys are learning. It could be fixed income, equity indices, commodities, whatever it is. In the more traditional space, there's been thousands of players, thousands of hedge funds, thousands of investment managers that for years have been building models, trying to get alpha, adjusting them, lots of competition for a small amount of alpha. That makes the markets very efficient, right? Now, when you look at cryptocurrency markets, these are very new, they're growing, they're evolving. If you have a good knowledge on how to build a model, then applying that into a new market, which is immature, which is less efficient, you can get a lot of alpha in a short amounts of time. And that's why we put a lot of our focus into crypto, right? Some of the issues in trading cryptocurrency are the fact that Ethereum's been around 3-4 years, right? So we haven't got that much data to go from when we're building these strategies. Ideally, a hedge fund would want 20-30 years of data to build our models. So we have a lot less data. That means we have more risk in our models. But when there's risk, we have the return, right? That's the idea. That's how it works. So we're trading mainly Ethereum short term and Ethereum long term. We trade on Binance. You might have heard of Binance. It's one of the largest cryptocurrency exchanges in the world. They have a higher revenue turnover than Deutsche Bank. I don't know if Deutsche Bank is still around much anymore, but their revenues supersede those. So they are huge. They really are a huge exchange. And on Binance, we trade cryptocurrency futures. So I think you guys are covering derivatives at the moment. So you'll go into a bit more detail on what futures are. But we trade futures so that we're able to go long and short with leverage, right? We want leverage because we want to increase our exposure more than the capital allows that we hold in the account. So we allow to get more alpha from the increased exposure, and we can also short markets. So only a year ago, it was very hard to short cryptocurrency markets. You used to have to go onto Coinbase or a normal app and you could just buy or sell. You couldn't short. Now we have shorting. The whole world of cryptocurrency trading changes, and we can apply more traditional strategies to this new asset class. Now what's much more interesting for me, and this may be new to some of you guys, is the world of decentralized finance. Now this is a whole new world, and I don't want to get too caught up in it because it can be quite confusing, but I'll give you some details on it. It's basically moving the whole financial world that we currently know onto a blockchain. Now a good example I use is if you consider a bank. So with the bank, they make money from the savings you deposit and the amount of return they make on lending that out, right? So for example, with savings, maybe you put your money in a bank and you're going to get 1% interest on your money, if you're lucky these days. But the bank may lend that out to a company or a person for 8%, right? So they'll make that margin. That's for the bank. Now in the world of decentralized finance, there's no middleman. There's no bank. There's no middleman to take a chunk of that revenue away from the users. So I can deposit my funds into a DApp. DApp stands for Decentralized Application on the blockchain. I can get 8% on my money, right? 8% return. I can redeem it at any time. There's no lockup periods. But I can also borrow from these DApps. I can also borrow. The interest rate will be higher. It might be 11, 12% or something. But more of the gain, which the banks used to get, now we can get as users, right? That's the benefit of decentralized finance. It's taking the power away from these large conglomerates that for years have been abusing the system, and making it a more equitable playing field. Let the users benefit in that upside. So that's a really exciting area that's growing. Decentralized finance is built on the Ethereum blockchain. Ethereum blockchain is ideal for this new type of finance because you can build applications on top of the blockchain, right? So companies can build their own company infrastructure on the Ethereum blockchain. You can't do that with Bitcoin. Bitcoin is a mere payments protocol where you just send transactions to each other. Ethereum is far more than that. So what we've started doing is, by all means, if you are interested, type in decentralized finance, also known as DeFi, D-E-F-I. There's a world of information that you can get really lost in, but this is definitely a growing area of finance. What we're doing is we are moving fund management onto the blockchain. So this is super exciting for me. There's no one doing this at the moment, and the hedge fund industry has been around for a long while. There's lots of issues with it, as many of you probably know. One of them is how secret they are, right? So they are not transparent by any means. So if I invest in a hedge fund, I give them my money, I give them $100,000. I don't know what he's doing with my money when he's trading it. I don't know if he's withdrawn it and run to the Bahamas. Bernie Madoff, I'm sure a lot of you guys have heard of him. He is a huge scam. So there's a lack of transparency in the hedge fund world from an investor's standpoint. I don't know what kind of risk that hedge fund manager is taking when he's trading, if he's holding my money. That's been an issue for a long while, and a few scams have come out of that situation. Another one is they're inaccessible, right? So you, me, all the other normal people around the world, we can't invest in hedge funds. You have to be a very high net worth individual or be an institution like a pension fund So that makes it quite exclusive to the wealthy and rich. So some of the hedge funds do extremely well, right? They make a lot of good returns, but not everyone can access these types of returns. So they've always been quite excluded. And another thing is security of funds. So as I mentioned, people have been known to run away with funds. It doesn't happen often. It's quite a regulated space. But with Bernie Madoff, people can abuse the system. Can't see what they're doing with your assets at any one time. So people can abuse it. So by moving things onto the blockchain, we can cover all those issues and provide a much more transparent, investable universe for people. So there's a website called TokenSets, TokenSets. It's a place where we can host our strategies on the blockchain. So the benefits of doing that is I've got 2 strategies on there at the moment. One of them has raised almost $500,000. But the good thing about it is people can look into that strategy and see those funds on the blockchain, right? It's purely transparent. They don't have to trust me saying there's $500,000 in there. They don't have to trust anyone saying that. They can see for themselves, so they know whether it's true or false. Also, when I trade, when I put on a position, everyone can see what position I put on, right? So if I suddenly go from cash into Ethereum, they can see that transaction happen on the blockchain and then see my trade. Now this is huge because for a potential investor, one of the issues they have is understanding what risk they're going to take by investing in a hedge fund. Now with this on the blockchain, people can see what positions the hedge fund manager has on at the moment, but not only that, he can see the track record. He can see what has that manager traded for the past 2 years. There's a whole list of his transactions on the blockchain that can be seen. So as a potential investor, I can make a more informed decision if I'm willing to take this risk with this manager. That alone is huge for any investment management company, whether asset management, hedge funds, family offices. That is absolutely huge, and that's a huge thing blockchain brings to the investment management world. Another thing is the track record itself. It's many people, when you go to a hedge fund and they'll give you a brochure and it'll tell you their track record, and you have to take their word for it. Yes, they can get audited, so generally they should be pretty accurate, but there's always bad actors. If you give them a way to abuse a system, there's always going to be 1 or 2 that can and will. So on the blockchain, and you can see all the previous transactions that fund manager has made in that fund, it's a verifiable track record. So if I tell my investors I made 80% last year, they can go through the transactions and see for themselves. They know if I'm lying, if I'm telling the truth. It's purely transparent, and this is for sure the future of investment management. Now there will be some hedge funds not liking this, right? Because one of the issues hedge funds have when people know what your trades are is people worry that other hedge funds are going to try and copy you, or other people will copy and try and learn what strategy you've got and copy it from themselves. Now, I think that's absolute crap. I mean, I don't know how you'd be able to copy someone's strategy just by looking at a few of their trades, but it's a concern they have. So from my perspective, I believe the benefits of the transparency we can give investors far outweighs the negatives of people seeing your trades and potentially it being copied. I just don't see it. But this is some of the issues they will have. So I don't want to go too much into it because it might be quite confusing for some of you, but this bit I feel is really interesting. So when someone invests in my strategy on the blockchain, they might send me $50,000, and in return I send them my own token. It's my own token based on the fund. I send that to them and they hold on to that token. Now that token has a price which is based on the NAV of the fund. NAV is the net asset value of the fund. So if they've given me, I don't know, capital that's equal to 1% of the fund, I will give them a token whose value is equal to 1% of the fund. And with that token, they can trade this wherever they want. It's freely transferable on the blockchain. You can trade it on another exchange. You can sell it off to another investor. You can redeem it at any time. This is huge, right? So if you invested in one of my strategies today and then a month later you're like, oh, I need that money. Well, hedge funds have lockup periods, right? They have redeemable periods. It could be 3 months, 6 months, a year, 2 years, depending on what strategy it is. On the blockchain, you can redeem at any time. So you can go back to the managers. It's called a smart contract, which is where they hold all the vaults, all the funds. And you can redeem your funds by giving back the token. You get your funds back immediately. Or you can sell your token to another investor if you want. You know, the possibilities on the blockchain are just endless for fund management. So I'll say it again, if you guys want to check it out, you can find me on Token Sets. There's 2 strategies on there. Have a look around, Google DeFi. For you guys to have a little bit of knowledge on DeFi, this is where the world's going. 100% sure this is where the world is going. So I don't know how much exposure you guys are getting to it, but there's lots of content online. Have a read. There's new businesses being developed all the time on chain. It's just making the whole financial system much more efficient by moving the middlemen. I think that's pretty much all I have to say on those. There's lots of information now. I've tried not to get into too much detail. I'm open now for any questions, or if you'd like me to elaborate on any more, please feel free. The good thing about trading on chain or doing fund management on chain is when you invest in the strategy, I give you a token, right? So you have control over the value of your investment. It's very different now to at the moment when you invest into a hedge fund, you give them money and then you trust that they do what they say they're going to do. It's different now. On the blockchain, I give you, someone invested in my fund, I give them a token which is equivalent of money back in their pocket, right? They hold the value that they have. So there's no need to have the trust, and that's why you have regulators, right? Hedge funds need to be regulated. They're not as regulated as asset managers because they're more complex, but they still go through regulations because they need to be trusted with people's funds. On the blockchain, there's 2 things. The first is they get the token, so they have control over the assets, the value of their investment. It's liquid. They're complete control of it. They don't have to trust the manager. And number 2, the manager never has access to the capital that's invested, right? So on my funds, there's almost 500,000 on them. I can't access that 500,000, right? So if I was a bad actor and I thought I'm going to go run away from the Bahamas, I can't withdraw all that money and use it. It's just impossible. It's through smart contracts. So smart contracts ensure that certain people who are authorized can only access the funds. So the fund manager can't run away with the funds, and the investor has control over the assets. These are 2 things which regulators try to protect, right? But they're already secure. It's already covered on the blockchain. So there's much less need for regulations, which is exactly why, if you look on Token Sets, they've got a good part that explains this. Should we be regulated? And the way it actually works is I put my own money in the strategy, I trade, and other people are almost mirroring my trade. They're copying it, right? So I have no access to other people's funds. I'm just trading along, but as I'm trading, it's trading other people's money as well, and it's trading their money as well. So that by having that structure, you get around regulations. That's not to say in the future there may not be a new type of regulation for the blockchain. Who knows? But the whole structure gets around the trust issue, which is why you have regulators in the first place. Yeah, so good question. So it's not cash. So on the blockchain, right, we have digital dollars. So they're cryptocurrency dollars, for example. So that's the equivalent of cash, right? Or you have Ethereum. So you can invest in Ethereum or invest with digital cash, USD. So yes, they invest that into the smart contract, and this is all done by maths, right? There's no human intervention. There's no human error here. There's no chance of manipulation. This is all mathematical. So the model, the security contract, the smart contract will take in the assets, maybe $100 in digital tokens, 100 digital tokens, and then it'll issue the equivalent value of tokens back out to that investor. This is all done through smart contracts. So smart contracts are so powerful because they automate so many things we currently have in the world, which require lawyers, lots of manual intervention, whole teams of risk managers. We can automate all this in a smart contract. As long as that smart contract is secure and has been audited, so a different risk would be, what if Joe Bloggs in his bedroom built a smart contract? Well, we don't know if that smart contract is going to be written correctly. If it's not written correctly, there might be problems. So that is a real risk. But if it's a smart contract developed by highly intelligent people that have a good background in it and it's been audited by a professional blockchain business, there's lots of auditors around, you should feel fairly confident that that's going to work as expected. So it removes all the need for trust and calculations. It's all automated. I hope that answers your question. If you're holding Bitcoin or Ethereum, yes, of course there's huge volatility. It's a volatile asset class. But if you're holding DAI, DAI is a US dollar on the blockchain. Yeah, so if I'm holding a US dollar on a blockchain, it's a US dollar. It's not volatile. It's always pegged 1-to-1. But if I'm holding
Bitcoin, between keeping normal US dollar or that cryptocurrency in US dollar, what is the difference? Why you should have that cryptocurrency instead of having real US dollar?
Great question. So US dollars on the blockchain are great because I can send my US dollars to Eugenio in Madrid or to Francisco in Brazil or anywhere in the world for about 10 cents, maybe less, and it will get there almost immediately, right? So it's transferable. I can store my assets on the blockchain. They're stable in dollar terms. There's also a GBP one, there's a euro one as well, but the dollar's the highly traded one. But I can transfer that freely around the globe without incurring high bank fees. I mean, I don't know how many times you guys have transferred money to the UK or anywhere else. There's huge fees, right? There's a lot of money you've got to pay on that transaction. On the blockchain, it's freely tradable anywhere, and you can use that however you want. Another reason why it's useful on the blockchain is for trading purposes, right? So exactly as one of your previous questioners said, it's what cryptocurrency is volatile. So if I'm holding Bitcoin and I've rode it up 100% rise, I want to convert back to a stable coin to bank my profits. And that's how many people use stable coins in cryptocurrency. So there's many benefits to having traditional assets or traditional currencies on the blockchain. There is, one of the issues I think with the integrations and the growth is the on-ramps. So on-ramp is when I have pounds in my bank account and I want pounds on the blockchain. There's companies called Coinbase that do this, but because there's not many of them, they charge 1.5% fees. It's not huge, right? It's still less than you'd pay sending your money to abroad from your bank. Your bank will charge you a lot more, but it still should be a lot less than that. And over time, as the market matures, the fees will be smaller and smaller. But that's the only main bottleneck. I love this question. I love this. And I often have a very good answer to this. How can the world trust a currency that has just printed or plans to print 6 trillion additional dollars out of free air, out of nowhere? How can anyone have faith in a currency with unlimited supply? So when the US Reserve says, I'm going to increase supply of the US dollar by $6 trillion, the effects of that are the average poor to medium term person that, they probably have $2,000 income per month. They're not extremely well off. They just get by. Their $2,000 they get each month is completely obliterated through inflation, right? That's a huge amount of money. I think at the minute the US had 16 trillion was the most amount they put into QE. They just increased that by 6 trillion. That's huge. So if you have a currency where you have unlimited supply and you can just turn on the taps like that whenever you want, you're eroding the wealth of the poorest people in society. And in turn what that does is it makes the wealthiest people, the people that hold real assets, the people that hold equities, they hold assets like homes, houses, that makes their wealth go up because that money comes straight into the system. It goes into equities. Inflation causes real assets to increase in value, right? But if I hold cash in my bank account and I'm not wealthy enough to hold assets, I'm screwed. And that's the problem with the US dollar. Now with Bitcoin has a finite supply. You cannot increase the supply of Bitcoin, right? It has 21 million Bitcoins ever produced and that's it. So it's completely inflation resistant and you don't have to trust a central counterparty. There's a whole network of people authorizing transactions, trusting this Bitcoin. So, for me, it's a very easy argument that, okay, we're all used to the traditional currency system, pounds, dollars, euros, but they all have unlimited supplies, which destroy the wealth of the poorest. It just doesn't make any sense to me. And no one realizes this. Every time they go through QE, they pump a whole load of more money into the system. The poor get poorer through inflation. Equities reach new highs. People get rich. All the wealthiest get richer. And it's just a completely crooked system. And I'm telling you now, in 10, 15, 20 years' time, we'll look back on this system and believe, I can't believe we let people get away with that. I can't believe we let them get away with it. Central bankers, all of them. How did they do that? How was that possible? With Bitcoin or anything with a fixed supply, you can't do that, right? If you hold Bitcoin, your price, the value is only going up. Now, the issue with Bitcoin is it's young, right? It's extremely volatile. You can't use it as a means of payment. It's still growing. Over time, that will happen, right? So it will reach to whatever level it will be, who knows. And then people will be able to freely transact because the price won't be so volatile. People may instead want to trade digital dollars, that have a fixed supply. Probably not digital dollars because they'll be pegged, but another digital stable coin, which does have a finite supply. Okay, people want to fight inflation. Inflation erodes wealth for the poorest. Looking at what the Federal Reserve are doing at the minute, I think it's absolutely disgusting. It's disgusting for so many poor people across the US that don't understand how the financial system works. It's pumping more and more money into it and trying to cover up their head's been cut off and they're trying to put a plaster over it. It's just not going to work. When we trade, we're traded against a benchmark. That's how performance is measured. So if I'm trading Ethereum, my benchmark is Ethereum, right? If I'm trading Bitcoin, my benchmark is Bitcoin. And what investors want to see is if I held Bitcoin from point A to point B, just held it, what would my return be? Versus if I invested in your fund, what would my return be? So would I beat Bitcoin? Would I beat Ethereum or not? Like the FTSE index, fund managers are measured against the FTSE or NASDAQ or whatever. So lots of people often said that Bitcoin is like the new digital gold, saying that it's a hedge in times like these that we're in at the moment. I'm not so sure. I'm not sure the data's there yet. We haven't got enough data to make that call. Over the next 6 months, time will be telling, right? We're in a global recession now. Things are getting really difficult. Gold's fallen. It's fallen massively. Gold always falls at the beginning of recessions. Happens in 2008 as well. It's ticked up a little bit now, but the immediate result is always to fall. But then Bitcoin fell as well. So at the minute, what we've seen, as we probably expect, is all asset classes to fall together. And that always happens, and that's why so many fund managers blow up, because they don't expect that to happen. Even though they know it happens historically, the models don't assume for that. And it's not because they're all correlated, it's because everyone wants liquidity, right? Everyone's taking money out of asset because they need liquidity. The future's uncertain. I want cash. Cash is king. But with gold, with BTC, Bitcoin, I'm not sure yet. Next 6 months will tell us if it's being used as a safe haven. People often ask me, there's just not enough data to say that yet. Ethereum, people say Ethereum is kind of Bitcoin silver. Like silver is used in industry, it's used for many different things, and Ethereum is used on the blockchain a lot more for building applications. So, I'm very much pro Ethereum over Bitcoin. I think the use cases for Ethereum are far stronger. And I think if we see Bitcoin rally, over the next 6 months as a safe haven asset, we'll also see the same with Ethereum and all the other assets. The whole cryptocurrency industry is highly correlated. So they all tend to move together to varying degrees. So I think they will move together. And on the models, so they're quantitative models, so they're trend following. So we do lots of statistical analysis on different type of technical indicators, and we try to devise trend following systems that are weatherproof. Now, some of the issues with devising a trend following system or any quantitative system is over optimization, as I mentioned at the beginning. So essentially what it's trying to do is identify when a trend has begun and confirmed. When a trend begins, it will obviously enter, and it wants to ride out those large trends and closes at the top. Same on the short side. Some of the issues with trend following systems is if markets are stagnant like this, moving sideways, it will get whipsawed and you'll be in, out, and you'll make a lot of losses. But when you get nice trends emerge, which you get in cryptocurrency a lot, which is why it fits quite well, it tends to make money in those moves. So there's pros and cons to trend following strategies, and you just need to be aware of them. But like building any model, when you have a little amount of data, there's risks, and crypto's not been around for long, so there's risk. But so far the models have done very well. So yeah, let's hope it continues. Okay, well, I think the most obvious way it will affect it is reducing costs, right? So when you transact overseas, as I mentioned earlier, there's huge transaction costs. Not only is there transaction costs, there's delays. So you pay a huge fee to have a 2, 3, 4 day delay in receiving your funds. This stuff is just madness. You know, with 2020, times moved on. How is this still happening in this day and age? It's ridiculous. So if they use their stable coin, a cryptocurrency, they could transact that immediately. The receiver would receive that in 10 minutes, at the most, maybe 5 minutes, and they have the asset in their own control, in their own wallet. So it all should make the actual international trade a lot quicker, right? There'd be less need for, what do they call them, where companies give you receipts, or they kind of guarantee your transaction will get to the other side before it gets there. There'll be no need for those middlemen. You know, they'll get the funds immediately, they can ship the stuff quicker, and the whole economy should just operate a lot faster, a lot more efficiently with less frictional costs. And I move on to the second part. I don't know if it will affect the value of traditional currencies. You know, it's hugely affected by supply. So I don't know, you know, US dollar is not going to change its value versus other traditional currencies. But what you will see is the slowly debasement of US dollars onto Bitcoin. So at the minute when we trade crypto, they're always priced in US dollars, right? So, you know, how many dollars have I made on my Bitcoin trade, regardless of how many Bitcoin I've made. But what lots of cryptocurrency traders is they trade in terms of BTC, in terms of Bitcoin. So they're based, I might start with 1 Bitcoin instead of $1,000. And can I turn my 1 Bitcoin into 2 Bitcoin or 1.5 Bitcoin? Or they use Bitcoin as the base measurement as opposed to dollars. And what that means is that we don't care too much about the dollar value of Bitcoin if we assume the value is ultimately going to go up. We care about accumulating more Bitcoin. And we can accumulate more Bitcoin by trading Bitcoin versus Ethereum, or trading Bitcoin versus another asset class where the currency pair doesn't have US dollars in it, it just has crypto over crypto. And that's how we can accumulate more of a given crypto based on the price ratios between the different cryptocurrencies, irrespective of US dollar value. So, you know, if what happens in the future is, what, you know, as I imagine in the future, if that actually happens, where we move to more cryptocurrencies and using Bitcoin, I think more things will begin. You know, this could take 10, 20, 30, 50 years, who knows how long it will take, but where things will be priced in Bitcoin, BTC. Right, there's a few websites, it's mainly just for jokes really, where you can buy like Lamborghinis with Bitcoin. But you know, it's a joke, but I think over time, that's not too far away from being the reality online, right? Where you can buy, I don't know, a toy for 0.0015 Bitcoin. And you just transact easily out of your wallet and into the seller's wallet. What I think is more realistic is that in my wallet I'll have stable coins, right? So stable USD or stable euro, and I'll transact my stable euro with the seller, and that will be the stepping stone to ultimate cryptocurrencies, because we want to get away from unlimited supply. We want to get away from inflation. You know, quantitative easing. This is just a massive joke, a massive scam. So we want to move away from that, but it'll take time. It will take a long while to get to that period. I appreciate a lot of the stuff I'm saying is probably controversial and not everyone probably agrees with, but this is just where my thoughts are and where I think things are going. Bitcoin has a network of what's called nodes. Nodes are miners. Okay, and the way it works, if I send a Bitcoin from me to you, that transaction must get approved by all the nodes on the blockchain, right? I don't know how many nodes there are, 100,000, I don't know, 1 million nodes. And they all must approve that transaction based on the track record, right? So there's one ultimate node that will give first approval, right? It could be anywhere, it could be in China. Okay, it's seen my transaction and it's put it onto the blockchain. Adam said Xavier, he sent him 1 Bitcoin. Okay, great. So now the rest of the nodes see that and they need to confirm that that's accurate based on the data the blockchain has, right? So if that transaction gets mined, I mean, it is quite complex. I'm trying to keep it simple. If that transaction gets mined, which means confirmed, that miner that first put it onto the blockchain gets rewarded. He gets rewarded with mining fees. So he'll get a small portion of Bitcoin into his wallet based on his work he had to do to confirm that transaction. So the work the miner has to do is mine based on his computing power. So the more computing power the miner has, the more chance he has at mining a transaction, and therefore the more chance he has at getting a reward from mining that transaction. So that reward comes from transaction fees I've just paid, right? So I've just sent you a transaction Bitcoin. I paid a very small amount of Bitcoin in a transaction fee, minute, I don't know, 10 cents, right? Really small amount. But there's 1,000 other transactions at the same time, all paying a small transaction fee, and this miner wants to put all of those transactions into one block, right? So there's lots of different blocks based on time, and they group transactions together, mine them into a block, wait for everyone to confirm them. If they're confirmed, it will get paid a portion of the transaction fees, which all us people sending the funds have paid. That's how mining works. Now, the issue with mining is it takes up a lot of computing power, right? So you may have seen them online. If you type in mining operation, there's huge warehouses with just mining operation, mining rigs, pure CPUs operating 24/7, trying to confirm all these transactions on the blockchain to get the rewards. These are huge businesses. Now, by doing that, they're using up a huge amount of electricity. So you see them mainly in countries with low electricity costs, mainly, not always, but obviously that eats into their margins, so they want to keep the cost low. And that's obviously bad for the environment, right? That's one of the things people have been arguing about, that mining is bad for the environment, all the CPU power, this isn't great, this isn't sustainable. Now, Ethereum operates in the same way, but it's moving from proof of work, which is mining, that's called proof of work, to proof of stake. Now, proof of stake doesn't require any miners at all. All it requires is for you to have some Ethereum in your wallet. So the more Ethereum you have, the more chance you have at approving a transaction. So there's no need to have computers doing mining, CPU usage. The more Ethereum I have, the more chance I can approve transactions, and the more chance I can get fees back from the amount of balance I already have in my wallet. So it's going from proof of work to proof of stake. And proof of stake is obviously far more better for the environment. There's no computers, all these big warehouses aren't necessary. And lots of blockchains are moving there. Bitcoin will never move there because it was built 10 years ago. And many people argue that the Bitcoin infrastructure is still quite old, right? It hasn't changed in 10 years. Ethereum, there's thousands of developers working on it, always improving it. Ethereum 2.0 is coming out soon. So it's constantly being updated. Bitcoin, people consider, is just like, I don't know, the holy grail. It's been made once, it's perfect, why change it? People have different opinions on that, of course. So, all global currencies are created or are managed by their central bank, right? Within Europe, ECB or Bank of England, they have complete control over money supply and therefore for complete regulatory oversight over that money supply, right? They want to be the boss, they want to control it, they want to know, they want to be able to increase supply or decrease supply, whatever's necessary. So what's with Libra, what Facebook are trying to do is create a new currency, but they're a public company. They're only a profit-generating company. They're not a central bank. So central banks are like, guys, you can't just create your own currency and just trade it. Like, that's what central banks do. That's what we're all here for. We regulate the economies based on controlling money supply. So, yeah, I mean, I think any company trying to create a currency to be used as currency, it's just going to be very difficult because you're not a central bank. How can you control, you've got to have regulatory oversight for that currency as well. Is Facebook got the resources to do that? I'm not so sure, not yet. But I love the idea of Libra. The idea was it's going to be a basket of traditional currencies, but in token form. It should be relatively more stable. It makes total sense. It's just that kind of thing, in my opinion, can't be created by a public company. You can't have that managed by a public company. Who knows what incentives they've got? Incentives to create profit, obviously, is their main goal. So yeah, that's the main issue around the type of organisation and oversight of it. Lots of central banks now, I think all of them, I think every central bank out there is now looking at digital currencies. They know they need to move forward. They see the benefits of having stable coins on chain, and they want access to it. And it's only a matter of time before people start creating it. I think the Federal Reserve were discussing the digital dollar, I think even a couple of days ago. So it's coming, but I don't think we'll see it from a private company or public company. Ethereum has definitely not been stable, right? Ethereum has been extremely volatile, right? I mean, let's look at, so if we go back on the 19th of February this year, Ethereum was at 280 in dollars. It's now at 134, right? So it's just fallen 50%. That's a huge volatility. That's a huge amount of volatility there. So it's extremely volatile. I mean, yes, it went up to $1,000. So I mean, imagine those gains if you bought at $1 and it went up to 1,000, right? It's a huge multiple of your return. But no, it's extremely volatile asset class. There's huge swings, there's huge moves, and that's why we like it, right? We want to see markets move, especially if we're trend following. So I mean, yes, coronavirus has had an impact. I think it contributed to the recent 50% fall. We saw all markets get hit, right? Because everyone, as I said earlier, wants liquidity. So, it doesn't matter what the market's used for, safe haven or not. If you need money, you need money. You're going to pull the cash out. And that's what happened to Ethereum. But no, it is extremely volatile. Do I think it will go back to $1,000? I think it's hard to say, right? Without question, these Ethereum Bitcoin are going to grow in usage. So if your assumption is that with more usage, there's more demand for Ethereum, then without question, the price is going to go up. I think it's only a matter of time before it probably supersedes previous highs and completely obliterates them, right? I see Bitcoin's price being something that we'd use as a benchmark for the cryptocurrency industry, right? Something like the S&P. I think it can easily get to $100,000 figures. The question is when. I don't have a magic round ball that can tell me when and how, but for sure this is the future. The trading volume's increasing. Central banks are now looking to apply blockchain to their own currencies. The numbers speak for themselves. I think it can go back up to those levels. I just don't know when. But I think they will be dwarfed. If you guys were to buy one Ethereum and I hold it for 5-10 years, I think you'll do very well for yourself. I think the hardest thing is holding that Ethereum for 10 years, right? Because we're all humans, and if prices fall 50%, we're going to cry and go crazy. But that happens all the way up to the highs. So yeah, it could return, but it's definitely a very volatile asset class and has always been. Crypto prices are very low right now, guys. So if you're looking at historical prices, there's a huge discount on offer on all cryptocurrencies right now. So on all of them, there's a sale on. There's a huge sale on, 50% off. But that doesn't mean prices don't go lower, right? So my advice to all of you guys, whatever little money you can spare, just buy a little bit of Bitcoin and Ethereum, I don't know, 10 euros, whatever it is, and put it away, right? So put it away for 5-10 years, don't even look at it, and come back to it in 10 years and just see what you've got to deal with then. It's got to be an amount that you can feel comfortable with, that you don't need. And also maybe it will give you a reason to follow crypto prices. These are growing, so it'll maybe give you a reason to follow this new market. So yeah, Bitcoin or Ethereum really would be my advice. So I do diversify, so I hold some gold. I recently traded euro dollars, so euro dollars went through the roof as interest rates came down. I don't really hold long term. I guess reasonably long term. I've held gold positions for a while. I hold no stocks, obviously, because of obvious reasons. But yeah, it's always good to be diversified, right? So having crypto as a part of that portfolio, I think, is essential. I think you guys are going to kick yourself in 5-10 years time if you haven't. And if it does, if it works out, fantastic. If it doesn't, okay, it's only been a small amount of money you put into it. So yeah, gold's a good hedge at the minute. Over the next 3 months, we're going to see gold reach new highs. It's the general pattern. Every time we have a recession, 2008 happens as well. So having a small exposure to gold wouldn't be the worst thing in the world. But of course, everything I say, tread with caution. I don't have a magic ball. I don't know what's going to happen in the future. I'm going to tell you my opinion. So gold would be good right now. Real assets, avoid stocks. Obviously, I think stocks have got a long way lower to go yet. So yeah, avoid stocks until I think we're around 50% level from their highs. At the moment, people won't use crypto for transactions, for buying goods, because I don't want to sell my crypto to buy a chocolate bar. I want to hold on to it. It's too volatile for me to want to transact it for small items. So I think in the future, for sure, right, whether that's a stable coin version or Bitcoin matures and it stabilizes in value, one of the two, without question, it's just a far more efficient way to make payment. Look at all the layers we have in traditional payment infrastructure. You making a payment in a shop, you making that one transaction through your Visa card, it's gone through about 6, 7, 8 counterparties to go from A to B, and all of those counterparties take a little bit of a fee through the way. If you pay with a stable coin, scan the QR code, it goes straight into the seller's wallet immediately. You've removed all those fees, all those inefficiencies, sped up the process. It's just so much quicker and much more efficient. What we're battling with is an old infrastructure, financial infrastructure, which has been in play for hundreds of years, right? There's thousands of different companies, some really large, some small, that all rely on this infrastructure staying in place. If that changes to this new infrastructure, all these companies are going to go out of business, they're going to suffer. So there's huge pressure on these businesses, on government and regulators to keep things as they are. So they'll often say things like, Bitcoin's a scam, only illegal people use it, and absolute crap, right? It's just not true. But they don't want things to change because they're going to die. These guys are going to suffer massively. So they still kind of spread negativity around, but it's not so much anymore. European Central Bank, well, they're going to have their own digital currency, right? They'll have the digital euro, so they want to be a part of it. They want to just have euro on the blockchain so that you guys can transfer your euros easily. But again, you have the same issue with inflation, right? They're still going to print money, just print it on the blockchain, and you're still going to have inflation. The value of your euro is still going to be worth nothing in 100 years. I saw a stat, I think, recently that the value of the pound over the last, I think it's 75 years, is now worth 1% of its value 75 years ago. 1%. It's just absolutely crazy what inflation can do to people's savings and income. So yeah, they're going to print their own digital currency, and I think they'll try to be a part of it. The question is whether Bitcoin takes over, right? There's nothing they can do if everyone starts adopting Bitcoin and transacting with it. I don't know what they're going to do. They'll try to regulate it out of existence. And again, that more negative propaganda, but we'll have to see.